Hi, everybody. This is the Physics of Bitcoin show. This is episode number 34. Yes. Uh, and today is 9/24/25. Um, like always, we give a little bit of an introduction about the show to explain what it's about. So basically, it's two physicists, astrophysicists to be precise. Um, we are both PhDs in physics, um, and we had kind of interesting eclectic careers where we changed fields, and this gave us an opportunity to study how to apply physics to these new fields with actually very good results because physics is very powerful. The approach from physics is very universal, and when you come to a new field from a different angle, many times you have like breakthroughs. um, this happened to me in my career, and same thing with Stephen. Then when we discovered Bitcoin, we also, it was natural for us to try to understand Bitcoin from a scientific point of view, from a physics point of view, using some of the tools that we learn how to use and apply to many different uh, problems. And like for example, we had some breakthroughs with understanding Bitcoin as a scaling phenomena that is a recurrent theme in physics. But it's not just the only thing that we discover using this approach. We almost every week we have some breakthroughs, not really major breakthroughs, but some new insights in how Bitcoin works, in what Bitcoin does, using these tools, and we present them in this show. So it's a very unique show because it's kind of we are sharing with you on almost on a weekly basis these new insight, new discoveries, because Bitcoin is such an incredible, interesting subject that you can dig. There are so many things, so much data that we have access, hash rate, addresses, price, what happens during the cycles. That one could spend many years studying Bitcoin and find new things. So, and this is what the nature of the show is all about. Stephen, you want to add or
Yeah, I just want
anything
to
to say?
say that we have been studying Bitcoin for many years, and we do keep finding new things. And it continues to fascinate.
Absolutely. Okay, say this. We can introduce the agenda for the day. Stephen has a very nice agenda, very interesting topics. You want to go ahead, Stephen, and show the agenda and start to dig in.
Okay. Um, so I've titled this a few different topics. I've titled it Difficulty, Bubbles Bursting, and Entropy. And when I say bubbles bursting in this context, I mean really bubbles not inflating and not bursting. The bubbles meme is what's been deflated, I think. In 2025, we haven't seen a bubble. We've seen really nice progress in the price. We've seen continued adherence to the power law. So that may be the bottom line of what I want to discuss here, but I'm going to talk about difficulty. And this is like a motivating factor for that conclusion is how difficulty is involved and evolved, and also the entropy, both with respect to the difficulty entropy and the price entropy. But first, I want to say welcome to the Zeta hash era. We're now consistently seeing hash rate at 1.0 Zeta hash or slightly above, slightly below. And that's an error when you do 10 to the 21 hashes every second by the collective decentralized supercomputing mining and minting network that has millions of machines in it, now all ASIC designs. And I'm going to talk about the evolution of the technology. And each double SHA 256 hash is itself over 1,000 calculations, a lot of low-level bit manipulation and bit level adds and so forth. But still, we're talking about more than 10 to the 24th operations per second, or a trillion operations per second by the world's largest decentralized supercomputer. So here's the agenda. Difficulty. First of all, difficulty is just hash rate averaged over the difficulty adjustment period of about 2 weeks, and then normalized. And the normalization factor is you multiply by the average block time of 600 seconds, and you divide by 2 to the 32nd power. So at 1 zettahash per second, the difficulty is 140 trillion if you had exactly 1 zettahash over a 2-week period. I'm going to look at the history of what we call the difficulty mu, and Giovanni has presented this for price, and I've presented it last week for price in gold terms. And mu is just all of the local variations of what could be considered as the daily slope, or in this case, it's going to be the slope at each difficulty adjustment, each 2 weeks, that I'm going to use as the data input source. And then we're going to see whether we can fit that to the T location scale distribution that Giovanni has found for price. And also, how has that evolved over time in the case of difficulty? We'll look at the difficulty power law. We'll talk about the technology influences and the technology progression and how that's caused the power law to change. And then we'll look at price versus difficulty and the approximate entropy for both difficulty and price, and compare those, and look at cross correlations of those, and look for Granger causality. Does price lead difficulty as one normally expects, and so forth. And then I'll transition to the price residuals compared to the price approximate entropy. APEN is an abbreviation for this approximate entropy algorithm that we use, and argue that there's been a phase change during Bitcoin's life, and that this change happened around 4 to 5 years ago. And basically, we've seen that the bubble phenomena has been weakening. Actually, it's been steadily weakening throughout the Bitcoin history, and during 2025, it just hasn't appeared. So why? And I have some suggestions as to why. And I'll close all of that with an analogy of 2 types of pendula, and how they may represent, in generic terms or general terms, as an analogy, those 2 phases that we observe. And I'll close out with the latest log periodic fits for Bitcoin price. All right, so first, the difficulty power law, and I want to argue that technology matters here. And I start this from block height 52,500, which is 1 block year, because for a long time, difficulty was just kind of sitting at 1 during the first year, and then it started to tick up slowly as the network built up. And so it was sort of, in a sense, artificially high when it was initially set at 1 by Satoshi. And you can see this chart starts with it around a level of 10. And this is a log chart of the difficulty ranging all the way up to higher than 10 to the 14th, which is the 140 trillion that I just talked about. And then the block height in log terms as well. And what we see is the first obvious little bump there is labeled GPUs. And that was a transition from mid-2010 and through 2011, moving away from CPUs for hashing towards GPUs. And there was some usage of FPGAs in 2012. They never really came to dominate the hashing. And what we see is that difficulty was actually quite flat during that period from, when it was 10 to the 6, a little above 10 to the 6, until we got to the beginning of 2013. And that was the major transition to ASICs that started really in early 2013. And there was a phenomenal leap of the difficulty and thus the hash rate by a factor of 4,000 by the end of that year. And 300 of that factor came from the increased performance per machine that ASICs were delivering relative to GPUs. And then another factor of 10 came as more and more machines were thrown into the network. Now, the first ASIC technology was in rather wide line sizes of 110 nanometers. And at that time, the state of the art was 22 nanometers. So it was already lagging technology at the semiconductor level. And they were giving up on a factor of 5 in line size, which meant a factor of 25 in area, because these were new designs. They didn't have much volume. So they didn't have access to, and really a volume of price support to go get the latest technology. So they've been climbing that curve ever since, and they now have reached the kind of Moore's Law path. They're now at 3 or 4 nanometers for the latest ASICs. So if you fit this overall, whether you do it as an ordinary least squares or do it as a quantile regression, you get a power law index of 11.1, very high R squared of 0.98. So you have a bump with the GPUs, you have a flattening, then you have this very big leap with the ASICs. And for the first number of years, they were playing catch up on the technology front in terms of getting their line sizes down and therefore more area to implement. These ASICs are highly parallel, actually. They're doing many operations in parallel because they can customize to the SHA-256 algorithm. And then we see some flattening in the later years. And also we have this transition away from China to North America as the dominant location for hash power. So some flattening is evident. And now the price versus difficulty power law. And this chart, I've excluded the early years with the other technologies. So this is ASIC era only. So if we go from the end of 2013, essentially, where the difficulty was something like 3 times 10 to the 10th up to the present day, then the price difficulty relation is not a square root. It's about the 0.7 power of the difficulty. And again, that's true whether you use ordinary least squares or quantile regression. They both give about 0.73. And the R squared's good, 0.93. So a value here greater than a half is consistent with some flattening in the difficulty versus time index that we saw, especially since the third halving in the spring of 2020. If you invert the relationship, it would be difficulty going as price to the 1.37. That's just the reciprocal of 0.73. Now, if you had no technology advance at all, you would naively expect that difficulty would grow with price. In other words, if the machines weren't getting faster, but price were going up, people would add to the network and you'd reach a new equilibrium, roughly linear in terms of a relationship, adding machines even though there was no advance with Moore's Law. But with technology advancing, you expect that difficulty versus price to be steeper than 1, but it, in general, probably not more than the square. And so that's what we seem to see, that if you take it overall, you might get something like price squared. But if you just go in the ASIC era, it's more like a 1.4. Okay, now the analysis of the changes from difficulty step to difficulty step. What is the local slope, the fortnight to fortnight ratio of the change in log price, delta log P, divided by delta log T, where T is the age of Bitcoin. And that's our mu parameter. And so this is the scatter plot for the mu of difficulty. This started after one block year of age, 52,500 height. And then we've got 2 lines fitting through it. One is a rolling median, 20 epochs, which is about one human gestation period. And then we've got the cumulative median, which are the purple dots. So that's all of the history up to that point. And the mean for this whole distribution is 11.9. So very close to the 11.1 that we see if we do straight regressions. A high R squared 0.93. So then the next question is, does it fit the t-location scale? And it fits quite nicely. This is a histogram of the probability density of seeing a certain value, a certain mu value distributed along the x-axis. We can see that it favors the right tail because it goes to over 200, but it peters off after about minus 50 or 60 or so. And the red curve is a gamma distribution. It does not fit very well. The t-location scale is the dashed green line. It's got this new parameter which measures how heavy the tails are. It's the thing, Greek, looks like a V, a Greek letter nu, 3.9. So that suggests heavier than normal tails, and we certainly see that, especially on the right side of the distribution. And the location is at 10.57, so around 11, and quite consistent with the 11.1 found through the power law straight regression. And then the scale is 13.5, which affects the width of this. So a very nice t-location scale fit. But I've gone on and I divided it into 3 different periods, and we see evolution in that. So there are 3 equal length periods of 5 years each, a little over 5 years each. The first one runs from 2010 May to 2015 June, and that's the GPU period, and then the first early part of the transition to ASIC. And that has a mean value or median value for mu of 13.53. Sorry, typo, 11.53. And then the second period is from middle of July 2015 to middle of July 2020. That was the China-dominated period for mining, a very rapid ASIC tech development, catching up and building up faster than Moore's law to kind of catch up to the technology curve. And that has a mu of 10.2. And then for the last 5-year period, from 2020 August until now, the average or median mu is I don't know why I put 7.5. It's, sorry, the mu fit is 7.5. So the t-location parameter is 7.5 and the median value is 6.2. So we're seeing that the t-location parameter drop from 13.5 to 7.5, and we're seeing the median drop from 11.5 to 6.2 in the distribution. And also that you see the new parameters are around 4, so they all have fat tails. But it's kind of interesting that the first 5 years, it's much more weighted to the positive side. It's a little more symmetrical for the middle 5 years and the last 5 years. And the last 5 years was the switch to outside of China, mostly North America, and ASICs catching up to the Moore's law curve. Really slowing to the Moore's law curve as they caught up in technology. Now let's look at the entropy. This is the approximate entropy technique that looks at all the short vectors and compares them, vector lengths of 2 in this case. And we plot the entropy for the log of the difficulty value itself and also the residuals. And it's actually, for the blue line, which is the difficulty itself, it's quite low until 2021, and it starts rising. And that's interesting because there's a pretty big jump that's consistent with when the Chinese hash rate migration occurred to North America and elsewhere. So there was a lot of dislocation for a while. This is a 4-year average for the upper chart and a 2-year average for the lower chart. And then in the middle of 2023, it started dropping and it's been falling ever since on the 4-year average. For the residuals, there's more variance. It's kind of chaotic in the mid-years, exceeding 0.5 for the entropy, but has come down to smaller value of late. And then if you look at the 2-year chart, which is the lower chart, it's broadly consistent, but you see more noise, more structure. It also has a couple of the earlier years. So you see very clearly the 2013 switch to the ASICs, which is that early peak in the difficulty line, the blue line. Now let's look at approximate entropy comparing difficulty to price. And here price is the orange line, and the difficulty as before is the blue line. And what we see is that the price entropy is higher than the difficulty entropy. These are also 4-year windows, rolling windows. So why would the price entropy be higher? Well, price faces many more influences: short-term shocks from news and regulation and liquidity, the behavior by the ETFs and the introduction of those, and the treasuries and how they behave. And of course, we've had the major bubbles, which have had external drivers, including liquidity and just FOMO activity. Difficulty is more mechanical. It's a self-regulating feedback mechanism with a clear short-term, 2-week kind of a clock. So it's more internally driven. So it's not surprising that it would have low entropy, and for most of the time, it's been below 0.25. So price entropy is higher because Bitcoin price reflects noisy, externally driven market dynamics. Difficulty reflects endogenous, rule-bound mining adjustment processes. Now we look at the leads and lags, and this is the cross correlation between those two entropies for price and difficulty, with different lead lags put in minus or positive from minus 26 up to positive 26 weeks. And here, if it's positive, then the price entropy leads the difficulty entropy. And we get a very high cross correlation of 0.994 around the 15 to 17 week peak. And that's a 4-month lead, and that's plausible in terms of ordering and installing new hash rate. So if price rises significantly and it's consistent, or even falls, and they want to cut back on hash rate, difficulty is a regulated lagged response here to price volatility. Then another test is Granger causality. And this has price leading difficulty on the right-hand side with the blue line. It has difficulty leading price on the left-hand side with the orange line. And to be significant, the probability needs to be below this 0.05 line, which is labeled, and across the chart. This is a log linear chart of the p-value. The p-value is the probability of getting this sort of outcome randomly. So if it's less than 5%, you're saying, well, this is probably not random, something's going on, interesting. And it turns out that difficulty entropy does lead for low time periods, 1 to 5 weeks. It will lead the price entropy. And perhaps that's due to traders picking up short-term market chaos signals. And we've discussed this in the past. More typically, you have a lower value with the price entropy, and it's significant for a 1 week, but also for 13, 14, 15, 16 week leads. So again, this is a 3 to 4 month thing that we just saw with the cross correlation. So price entropy is also more associated with falling turbulent markets than with smoother bull runs. So if we were to see a rapid rise in the price entropy, it could be a warning signal for an unstable behavior with a bubble popping or some liquidation cascade. Fortunately, we're not seeing that right now. If the entropy is low, trend following dominates, and that could be an uptrend or it could be sideways. And this compares the price residual versus entropy. Now with the 1 year rolling, I wanted to see the structure better. And we basically see two regimes. This dates from around 2016. And in the first half, we saw that the two series were anti-correlated. And so we see this, this big spike in the price residual, which is the 2017 bubble. And we see the entropy dropping. So it's a very ordered process in that bubble. And then, as that blue line falls, the red line rises, and then it continues to be anti-correlated through 2019. And as we get into 2020 and 2021, then it flips. And we no longer see that anti-correlation. It's either sort of uncorrelated, or later on, it looks like it's positively correlated. Certainly for the last couple of years, it looks like they're positively correlated. So in the past, price bubbles were strong, but regular, better behaved. Entropy has started to co-move with price as we've had more external influences that come from the derivatives and ETFs and the institutional buying and the macro liquidity and regulation influences, corporate reserves, state reserves. And what this means, more entropy means there's more turbulence at small scales, but without the big bubbles. So this is a structural regime change due to macro governments, institutions. Volatility is down, smaller swings, but entropy is up. It's less predictable. So my argument is that this regime shift has occurred, that it's due to institutional and macro influences, that we've had a fading of the large, low entropy ordered bubbles that were retail driven and exchanges activity, and replaced by choppy behavior due to an institutional regime with larger capital volumes and all of the net buying this year happening from institutional money. The Bitcoin treasury companies first and foremost, and then ETFs, and the governments, the nation states are the third category in terms of the Bitcoin in treasuries. And they're approaching 4 million Bitcoin in aggregate. Now, we should remember these are all custodial in nature. They're custodial for their shareholders, for the Bitcoin treasury companies, and for investors in the case of the ETFs, and for citizens in the case of nation states. But over the last 30 days, they've been increasing their holdings collectively at over a 21% annual rate. And if you look at the Bitcoin treasury companies, the largest ones, they've been increasing their total Bitcoin holdings, many of them by double digits, and in some case, triple digits, and Metaplanet even higher than that. So the treasury company holdings have been growing as something like the fourth power of Bitcoin age in the past several years, at least for now. That will have to break because there's a limit on what they can acquire, but right now that's holding. So the physics analogy is between a periodic behavior or a chaotic pendulum. So a single pendulum, a simple pendulum, we know that has periodic behavior. It's low entropy, but it can swing broadly, so that's high volatility. A double pendulum can exhibit chaotic behavior with high entropy, even though the swings are smaller and lower volatility. And I've got a little video, which I think I have to go out of to display this. Kind of fascinating to watch. So Bitcoin's market dynamics have evolved from a low entropy, high amplitude swing into a higher entropy, lower amplitude chaotic pendulum. It's the simplest physical system that produces deterministic chaos. And the analogy is a transition from simple boom-bust cycles to a more complex and entangled regime, entangled with external influences. We could all watch this for a while, but we have limited time, so I will escape out of there. And go on to our latest log periodic power law results at various timescales, intervals of 2 years, 1 year, 4 months, and 1 month. They're broadly consistent, but the price level has come down and the time has moved in for the longest of these, the 2-year. Interestingly, it's moved into November 25th, which I think is a very special date to Giovanni. It's got an R-squared of 0.96, and the price level would be 139,000. And the standard arrow, that blue shaded region around the curve, is $9,000. The 1 year, it's showing a bounce into next week that could take us up to around 120,000. The 4 month, which uses 4-hour bars, says in early October, 113,000. And the 1 month shows a downdraft that would occur in late October at right around 100,000. So if you plot those 4 price points, they're suggesting a weak October, that we fall through, the first several weeks of October, and then, rebound from there as we go into November and could recover as high as 138,000 or so around the end of that month. So thank you. And I will close that out. You have comments?
Yeah, great. All this looks very good. So if you bring back slides where you say there are 2 different regimes, that we actually.
So that's the evolution of the difficulty.
Mm-hmm.
And then
let me see.
Here are the different regimes.
Mm-hmm.
So this is the entropy of price over a 52-week rolling window, and the price residuals. So the upper half of the chart are the price residuals, the blue line, and the entropy is the red line in the lower half.
And when this happened exactly?
2020, 2021 was this shift.
2020, 2021. Do you have any idea of?
So the 2021 peak, in 2021 we had a double bubble, right? So you see the double bubble in the log price residual, with the April one being higher than the one in the later on. And you see the entropy is quite flat through all of that. So it is not anti-correlated as it had been in the 2017 bubble, and as it had been in the middle of 2019, and as it had continued to be in early 2020. But now, as you get to the end of 2020, the anti-correlation evaporates.
Yeah. So why do you think we went from correlation to anti-correlation?
Because institutional money was coming in.
Mm-hmm. And why that will create an anti-correlation?
Because institutional money and macro influences, first of all, there are many influences, right?
Right.
So you had the availability of not the ETFs, but the trust, the GBTC trust, which dates from around this time. You had the derivatives, the ability to trade on the CBOE, right? So institutional money, CBOE or CME, anyway, in the futures market, you could trade. So you had institutional money coming in to those vehicles. You had liquidity influences mattering more. And you had the regulatory regime starting to shift around that time. And the corporate reserves began in August 2020.
Yeah.
August 2020 is when strategy shifted its strategy.
Yeah. When strategy became strategic.
When micro went macro.
Right. Yeah, it makes sense. It makes sense. Sure. Good.
So it's interesting that, in fact, those were the early days for institutional influences. But then, as we got into 2024 is when the ETFs got approved.
Right.
So there was kind of non-correlation, uncorrelation for 2021, 2022, and 2023 actually looks a little anti-correlated. But by the 2024, when the ETFs kick in, we became positively correlated, mildly.
Right. Sounds good. Yeah. Makes sense. It's very good. And this shows how these type of more detailed analysis using more sophisticated tools can pick up these things. With normal indicators, the normal TA analysis cannot do that.
Right.
It's very powerful. Okay. We can go back later and see if there is any question. Oh, we can do something different. Maybe see if there is a question related to what you just presented. I don't see any related to.
I'm not seeing anything in the chat. Huh?
Yeah. Okay. So I will go ahead and make my presentation. It's still a work in progress. Let me see if I can make it larger. The last few times it worked, right? Whatever I was doing, it helped with. What about this? Does it look better?
Looks good.
Okay, good. All right. So I'm continuing this idea, and at a certain point, I'm thinking almost like to create like a multidimensional distribution, to see how, because you can do a one-dimensional distribution, but maybe we can do a two-dimensional one at least and look at price versus addresses, and hash rate. And one time I did, I don't know if you ever saw this 3D graph of a 3-power law, right? Hash rate, price, and I want to do something similar with these distributions. Anyway, so this is the latest, and there are two type of addresses with, in fact, many type of addresses. We could create different cutoffs, with different balances in the wallets. We can look at the active addresses, and so it are all different ways of understanding these addresses. Addresses are important because we could use them as a proxy. It's a rough proxy because, we don't know exactly how many Bitcoiners are there. One could take some estimates from exchanges. Now we have also the ETFs, but it's good actually that there is no a way of tracking down how many Bitcoiners, right? Because it will require some kind of signing off, right? I have Bitcoin, so it's good that there is some level of anonymity associated with this, but it's also nice to have that information. And I think addresses do a good job also because, there is an objection often, well, one person can have many addresses. It's still going to look as activity, right? This person is doing something. And anyway, if we look at relationship, even if there is some kind of a multiplier, right? Let's say, okay, in average, how many addresses a Bitcoiner is using, right? Maybe whatever, 5.3. Okay, when it's just, this quantity is nothing else and user times a multiplier. And when you do a graph like this, it doesn't matter if it is a multiplier. So it's still, I'm trying to make the point that it is a very good proxy for activity in the nectar. And so if you do a graph of addresses versus time, and you do it in a log plot like we do with everything else, you see this curve, the black curve, hopefully is clear enough. And then the best it's not an exponential because it looks curved like always in a semi-log graph. It is or log linear graph where you take only the log of a y and keep of a time linear, and it looks like kind of like a straight line. Now, one could argue that maybe there are two regimes. There is this regime up to whatever this thing happened that is associated with one of the bubbles. I think the one in 2017. Something happening to Bitcoin is something that needs to be explored. Some big changes happened to in 2017. Like one last time, for example, we saw that for the price, this quantity sigma, that is how spread the distribution of these slopes are, change basically at a jump. It started to, well, it went up slowly just before 2017, and then it stays stable after that. So there is something important happened to the nature of Bitcoin, of how Bitcoin behaves in around 2017. So one could also argue, well, it seems almost like this was pretty straight and you kind of follow this red line that is the best fit of all the data. And then, there was this increase, there was kind of an explosion of these addresses, and then some regime change happened. And here you see another straight line with a smaller slope. That could be an interpretation, and I want to explore it. I want to see if I can make two models with two different power laws. It could be that somehow it was like a phase transition, and it's still scaling up, but for some reason the scaling is slowing down. It doesn't have the same steepness than before. Usually I don't like to do that because it makes the model more complicated. It's better, it's nice if we have one single straight line. If we see that this doesn't recover and it goes back, one reason not to do that, one could say, well, see here accelerated, then it decelerated, maybe it's going to accelerate again. We will have to see. If that happens, maybe we can stick with one power law. Otherwise, maybe it's better to split it in two, like in two different regimes. Something that we can explore. Now, the method of a daily slope actually help us with that because it doesn't marry itself to a particular slope. It actually it assumes there is some kind of scaling process, and then it calculates the n. So we should see, and I say this because in fact we have some hints when we do that, that there is this interpretation maybe is correct, that there is a change in the slope for addresses. That it is interesting because when I think what happens, and this is something that needs to be explored better, that the price reaction to this change actually was where it compensated. So we are going to study this change better in the next few weeks, because I think I noticed that somehow if you do price versus addresses, you see a compensation of that, where this ratio between price and time then kind of stays the same, because we always say that basically what we see in price versus time is nothing else a combination of how addresses are growing in time and then how the price reacts to addresses. And because we don't see a huge change like this in the price, the end of the price stays pretty stable over time. Is the only interpretation is that then, if this is correct, that there was a change here, is that is compensated by a change in price versus addresses. But I will try to make a case for that next. I see some hints that is the case, but I will try to make a stronger case for that next episode. I will explore that. Now, let me show you the next graph. It is not this. Sorry for that. Okay, so this is, we usually start from here, right? We show how the addresses change in time, right? So if I take, in this case, we are showing a log. So I take the ratio between addresses today over addresses yesterday, right? So the percentage change in addresses. I did this for price, I did for hash rate and so on. For price, I can show you a graph. I want to remind you how that looks for price. For price, it looks, now, well, here is messy. And I didn't take an average, so I need to redo that graph so you can see it better. I think actually I have it here. So if you take the average of a change, right, basically what is called the returns of a price, and there are oscillations because of the bubbles, right? Here there was a big bubble, so it kind of deviate. And so here this quantity, it's a yearly average of a returns, of a daily returns. So it will peak here during a bubble, and then it will go down and have a minimum local minima at the lows when we have a cycle lows, okay, here. But in general, you see, it seems it is going down, right? So not just the peaks are going down, but the entire curve goes down. These are the declining returns that you will expect if we were dealing with a power law, because we say this multiple times. Most assets are exponential, and if you did this graph, in fact, maybe next time, because we are exploring this topic, I will show you how this looks like for SP 500, for gold, etc. They look pretty flat because most of these processes are exponentials. When you have an exponential, the returns look flat. They are constant in time. Now, of course, they can oscillate because there are also microeconomic cycles for the stock market, etc. So we will have peaks and lows, but in general, they look flat. But it doesn't for the price, right? And then the entire point of looking at these daily slopes is if we divide by this quantity that is a log of t plus 1, where t is the age of Bitcoin, over t, the age of Bitcoin in days, you divide by this quantity that is a mathematical quantity, right? It's a deterministic quantity. Then this curve that is changing in time becomes stable in time. But you see now it's oscillating around a stable value that is actually the global slope, that is 5.9. So this is really cool because now you found something that is stable in time. And then you can look at these statistical properties like the average. You can look at this is why we do this distribution with T location scale, because then we can study how big the tails are, or this. It doesn't, first of all, we can determine, it's not really a Gaussian. It's a more complicated type of distribution that has very big tails. It's very interesting to know. You can even characterize these tails as a function of time. You can characterize how spread of the curve is. So you go deeper in characterizing this power law behavior, right? So we go beyond just drawing a line where, okay, you can calculate the R square, maybe you can calculate the deviation of the residuals. It's similar, but I think this is deeper. It goes a little bit deeper in the properties of Bitcoin, and you can use it. You can make even indicator that tells you when we have local lows and local high, because I just showed this like yesterday, for example, the indicator said we had a local low, and you can do this because you can calculate these quantity at different time periods, right? You can do it on a fast windows, a few days, and compare it with the possible deviations from these new quantity, calculated maybe over a few weeks, and that tells you what to expect, right, over scales of 2 weeks. If you go beyond the plus 1 sigma or minus 1 sigma, we are expecting some kind of return. And in fact, this is what happened. We went too far a few days ago in one direction. There was, a negative correction, and we had a small little rally that brought us away from that. It was pretty well. I showed last time how this looks like. So we did the same thing with hash rate. Hash rate looks like this. Sorry, this is addresses actually. I'm spoiling. We did it with hash rate. It looks like this, where again, you can see there is some kind of decline over time, and the red curve is what you will expect. It follow perfect power law, and you can see the red curve is a good measure, right? It's a good model. It's not just doesn't just work in the log graph of addresses versus time, but even the change of addresses versus time. It's a good representation. Like even just with your naked eyes, it looks like it kind of models pretty well how this quantity changes in time. And the same thing that happened with the price, where I really like this transformation here, right? What I show you before, that if you divide by that quantity, then you get something that is flat. Here, you get something that is flat. Instead of decaying in time, it's flat, and it's simply oscillating about 5.9. And it seems pretty consistent over the entire history of Bitcoin. Like I say, is here, and this the graph that I was showing here before. So if you average it over 1 year, this daily slope, and you normalize by the mathematical quantity, it looks flat like this. So you go from this to this, and this looks much nicer, right? Because now you can say, instead of worrying about this decay and trying to represent it somehow, now you have a quantity that is supposed not to change. Now, this is also useful to tell us if we are continuing to move along the power law. If we don't, we will not oscillate any longer around these 5.95. And this is what I was telling you. You can make actually a pretty indicator with where you calculate that mu quantity over different scales, like a short time, like maybe 3 days, and then when it crosses the 1 sigma for the slower one, so 1 sigma deviation in both directions for the slower one, you get local minima and maxima. And yesterday actually found a new grid dot. Okay. And like I said, this is now I'm going to show you how this looks for addresses, right? I just show you the power law for addresses, how this quantity, that is a change in addresses, looks when you plot it. It looks like this. It looks a little bit different. Same thing, like these values are high. It's a little bit strange because even if it were wild oscillations before, it still kind of overall went down. Here, it looks like kind of stay flat here in this region. And then this is that big change here, right? This kind of bump.
So, question about that.
Yeah.
That's 2018. So that's when the bubble collapsed, the 2017 bubble collapsed.
Yeah.
This is 2018. So is this saying everybody emptied out their addresses so they became zero balance addresses because they were moving coins onto exchanges to sell them?
Yeah, we need to explore what happened, because something drastic happened there. It was, this looks like a phase change, like, some big, huge event that created some kind of dislocation, like you can see it even here, right? So maybe this interpretation that something happened and then we had a new power law, that is very interesting because we kind of see that also with hash rate, like you mentioned several times, that there is some kind of changes continue to scale up, but there was some kind of drastic change. So, I don't want to make conjecture. I want to explore it better and get and dig more and look at what exactly happened there and try to understand it. But here, see, this is a very powerful tool because you can see better these kind of changes and identify different regimes, right? So this interpretation of maybe there were two different regimes makes sense. We should look it up. And here now, if you divide, and that is still okay, because remember, when we divide by log of t plus 1 divided by t, we didn't divide by some precise n. We actually say that if I take the log of a change in addresses over this log t plus 1 over t, I get n. That is n. So it's the local n. And so if n changes, we should see a change, right? And you kind of see here, I didn't do yet the moving average, but you can see here also with your naked eye, it's kind of flat here, right? Then there is this big change exactly at that time. And then, bam, it went down to this level, right? And then it stayed stable from here on. So there was a change, right? It seems that there is a change. That is interesting. So we could fit this data up to here, calculate what the n was there, the average n. Now, the average n over the entire data is 2.5, something like that. And the global slope is that I'm drawing here is 2.7. So it's so probably what happened is it was a higher slope here, maybe bigger than 3, and here it went down a little bit lower than 3. But this needs to be explored. With your naked eye, I'm going to do a moving average. I'm going to divide the data, calculate the average. We could, in fact, if you are patient for a second, I could even try to calculate it on the spot just to give us a feeling. I can do it. I can calculate. How did I call this quantity? Just a second, because now I'm curious myself. I was working on these in the last few days. This all the progress I did so far, but let me. Yeah. So if I take the total average of all of this quantity of the daily slope, I get 2.37. But if I take only, let's say, up to the first few points, it's like 3.2. So it was higher than 3. That is this is usually what we say. And if you do the one single power law using regression, you get 2.7 as your slope. So it's possible that we were going above 3 in these. So just calculate. It seems that is the case. We had a higher slope here, and then it went down.
You remember that paper that Didier Sornet wrote about the behavior of small balanced wallets, medium and large wallets, right?
The one about the you show that actually there is a power law for holding times. That one.
I think that was part of what he showed.
Right, he showed many things.
Basically, we know, and he showed that the smart money, high balance wallets,
right.
Take a little bit off the top, right?
At
the peaks, and the small and medium wallets buy and sell at the wrong time, right?
Mm-hmm.
They behave as dumb money. Now, with you couple that fact that we know that the power law is steeper for the smallest balance wallets than it is for the large balance wallets.
Yeah.
What we're seeing here is a shift from between dumb money and smart money.
Yeah.
So the dumb money,
and then like I was saying,
selling to the smart money
price, Correct.
Yeah.
And now the
Yeah.
price, I was saying, the reason why we don't see that change in price versus time is because the reaction. So here, this that is a very beautiful interpretation. So these are so basically we are switching to kind of less casual investors. These are smart money, big wallets, big investments, and that growth is lower because it's not. It's kind of like maybe they are not all whales, but let's say they are dolphin and
Mhm.
above,
Mhm.
and that growth will go slower because there are not many of these people, you know. And we already showed that in the past. I had a graph that showed the different wallet balances and how fast they are growing. They are slowing down. What happens is that the price reaction, that basically the Metcalfe law, becomes stronger. Instead of being just two, it goes to 3, 4, 5. In fact, I remember when I did this graph where I show price reaction, price versus addresses for the large wallet, it was all the way to 5 for the largest wallet. So it is still compensated, right? And we will show next time. We can do price versus addresses and show there was a shift here where the Metcalfe law became stronger. When here it was weaker, it became stronger. Like for stronger, I mean higher N. And then the two balance, because that was the result also of that graph. Do you remember I did that graph? In fact, I think I have it somewhere here. But, do you remember that graph? Or, some time ago I did that, Stephen. Yeah, it was this one.
Which graph?
I did this
Yeah.
graph where I
Oh,
have
okay. Yeah.
different
Yeah.
cutoffs of
Yeah.
different cutoffs of a wallets, right? I look at shrimp, crabs, dolphins, whales. I should have written here what are the cutoffs, but I think I went, 1 Bitcoin, 5 Bitcoin, 10 Bitcoin, 100 Bitcoin, and so on. And you can see what happens, right? If you look at how addresses versus time goes, it's basically the same shape. You see this exactly same shape of the graph, but they are becoming less steep, you know. But this is overall, right? So it's possible. In fact, you see actually how that bump became smaller. It's probably because it's phase transition, it was less, right? Because you have more of these guys, basically. It's kind of a continuation. That is your interpretation, right? The phase transition was less violent because basically we are having more and more of these big, large wallets, right? While here you had more retailer. So basically, this is what you're saying. We see less retailer, right, as we go in this new phase. Basically this is what you're saying, right?
Mhm.
And so you can see how. See, these are the sloping times, right? For the large wallets, they became smaller. So we go 2.91 for everybody, and it's 1.8, basically almost linear for the whales. And then how the price reacts to the addresses growth. We go from 2, that is a typical Metcalfe law for everybody, all the way to 5. And so that is really cool. But then the result is that you see these red lines is basically the model that you get by combining these two. They are all power laws, and they are all in top of each other. It doesn't change. It doesn't change the price versus time, simply because the two balance. And this is what I was trying to explain. But we can look it up in that, because we should be able to calculate N for the when we do price versus addresses. We should it should be the equivalent of doing this. We can do it with so instead of dividing by t plus 1 over t, the log of that, we divide by the log of price. If you do price versus addresses, you divide the change in price by the log of addresses today versus addresses yesterday, right? And we should get this n as a function of time for basically the Metcalfe law. So I will do that, and what we should see that n jumped instead of going down. and then the two balance each other to give us basically that 6. When you multiply one exponent by the other exponent, you should get 6 or 5.9, whatever it is. So this is very interesting, and actually, again, a new discovery. And I really like a lot of your interpretation. I want to dig more and have a little bit more evidence that is exactly the case. So it's possible that this event in 2017 shook a lot of weekends and casual investors, like little retailers. And then we went from, we had, and also maybe there was, the first round of, like institutional investors. Because I remember at that time, we were talking about, Pantera and other large firms buying a ton of Bitcoin. So that could be also that. But it's interesting that then, since then, this quantity stayed pretty stable. That is really what I love about this quantity, because it tells us if there is a change in the power law, and if we didn't follow power law, it will not be stable in the first place. It will be different. In fact, I can show you an example. Next time I can make some theoretical example, because I want to use also these as a way to tell us we are not following a power law if we are not following a power law. And you will see, for example, if we are dealing with an exponential, with this operation of trying to normalize or stabilize this quantity will not work. It only work if you have a power law. But also it's interesting because if there is a change in the slope, this also will identify that. And this is the case for this quantity. So it's really cool. Now I fitted the entire distribution. So it's, even with this change, it will try to find the best fit possible with all the data. But it will be also nice next time to divide it in two regimes and have two distributions. But if I do it with all the data, I still get a pretty good approximation where mu is that 2.3 or something, and it is kind of the average value between all the different mu's. But yeah, maybe it's better to do two, one for this region and one for this region. That is what I will do next time. I will go deeper and try to understand this better. And it will be very interesting because this will be worth it out, a few posts to explain people that, with addresses, we can see this change because many people ask that it's one of the recurrent questions. Can the power law change slope? Now, many people are hoping the price power law changes slope. But that is interesting that actually it's such a strong property that even when the type of investor changes, because of the entire mechanism, right? It's not just how the addresses grow, but also how the price react. The two balance each other. That is, again, one of these things that only few people know, but if you look into it, it's really a beautiful, powerful idea that these two things kind of balance each other in the end, right? That the system wants to keep stable, So the way that, because it could have reacted in a different way, right? It could be, I react strongly, more. Yeah, it does, but not in a way. Why does it want to balance in the end? Why?
Right.
That is really interesting, right? Why this scaling property between price and time really stays stable over time, even if, because this will be a very strong proof. I thought that dividing the wallet in many different sections, it is like an underrated result, which should have been discussed more. More people should bring it up and say, well, look at this, it's so cool. It's kind of ignored by the majority of the community. This is why we need to write all this paper. At least we know that, okay, we publish the paper, it's fair, maybe it's still ignored, but it's a place where people can find it. But it's a kind of very interesting that, the stability of this scaling property between price and time is there, even when there is a big change like that in the type of investors, right? In the type of institutions, and it's another sign of stable, or how stable these scaling properties are. In particular, the fact when you have more than one property, one or more of these scaling property working together in a feedback loop, right? Because you have the growth of the addresses, then how the price reacts to the addresses, and they combine and they create some kind of feedback loop. And this feedback loop tends to stabilize things. They are kind of error correcting processes. One way of thinking about them. So it's really fascinating stuff. Okay, yeah, more things to investigate for us. That is good. Any further comment on this or suggestions?
No, back to my comment of an endless source of fascination. There's just more and more to dig into.
Yeah. Okay. So he has questions, opinion about you about the simulation theory. I think there is. So I really like ideas where for example, I am a fan of Stephen Wolfram, and he has this entire theory. I already show the book. I have it somewhere. Where is it? Where he has this idea that the universe is computational, that is basically like a program, that is the manifestation of all. If you look at all the possible, he calls it Ruliad. So you can draw a theoretical diagram representing all the possible rules, kind of logical rules that you can create. And then you get physics by taking sections of these, hyperdimensional structure. And then he even explained that consciousness is us, or basically some kind of entity that has enough complexity to take information from this structure and process it. And that gives basically a history in time. And that is what consciousness is. It's a very beautiful theory. I like it a lot. And it's about network, basically explains that the universe is a network of rules, of possible logical rules. And then he's able to derive, even if it is at a very higher level, different physics law. Like, he was able to derive relativity, he was able to derive gravity, general relativity, many different things. And explain that, you can use this model to actually arrive to this particular behavior that we are observing in nature. Now, I don't like the idea that there is some kind of a programmer, because it becomes basically creationism all over again. And in fact, many religious people, they believe that there was a God that did this and created the universe like that, because they think that the programmer is God. And I think that is a very naive idea of how the universe came into place, because God is complex, and nature, the laws of nature, in particular in the beginning, when everything was unified, are very simple. There was very little stuff and very simple rules, and everything came basically. We have a lot of evidence, if you study cosmology, that the universe came from nothing. There is an entire sequence. In fact, one of the way of deriving the physics law is through this idea of symmetry, that symmetry gives rise to conservation laws, and then conservation laws give rise to physics, to the laws of physics. And there are crazily incredible symmetries in physics not just conservation of momentum, angular momentum, energy, but all, if you go deeper in subatomic physics, there are very, very high level of symmetries. There is a book that actually was written by the brother of my the brother-in-law of my boss when I was at Northwestern. That is so strange because I know it's a small word. The author is Z, a physicist called Z, and he wrote this book called Fearful Symmetries. And the reason why we all have these symmetries, because think about what is one of the most symmetric object that you can ever imagine. Nothing. Nothing is very, very symmetric. And basically, what we observe in the universe is nothing with a small little of symmetry breaking. You broke a little bit of that symmetry, and you got raised to everything. Just to give you another example, if you calculate the total energy in the universe, you know what is that number? Zero. The positive and negative energy cancel each other. So there are a lot of clues. The universe is flat. That is what you will expect from a universe coming from nothing. The universe comes from nothing. I know it sounds difficult for many people to understand that, but yeah. So I don't like ideas about simulation theory that are claiming there is some kind of programmer. Is very different. I think from idea that the universe is programmatic. It's basically kind of like a program, but it kind of written itself by basically exploring possibility in all the possible rules in the universe. I like that idea. And there is this idea where there are many universes where the laws are basically other type of combination of the laws of physics that will not support life. It's called the anthropic principle. The only place where we could be is a place where actually, if you have many different possibility and combination, right, you will have billions of possible universe, trillions of possible universe. The majority of these universe don't have life. We find ourselves, we kind of won the lottery, but in the other universe, where we lost the lottery, we will not be able to even think about, right? We will not exist. So we live in a universe that supports life simply because they have, many other universes where there is no life. So this is my understanding. This is where, after many years thinking about this stuff, and I think a lot about this stuff, I concluded. Yeah, and there are many other reasons to think that simulation doesn't work, right? A simulation usually is something that is simpler than what is trying to simulate. And if you study the universe, right, it's very difficult to think that all these things that we observe are, a simplification of something else that is over there, right? And if that was the case, then you're basically shifting the problem, right? It's almost like saying, okay, what is under the earth? A turtle, all right? And what is under the turtle? Another turtle, and third turtle, right? So it doesn't really solve anything, right? The question then it will be, okay, when the universe is the person doing this, these people that are doing the simulation and their universe, including a universe. Then you change the definition of universe, and then the question remains: who created that universe, right? And how that universe was created. So I think it's very lazy, this idea of simulation. What do you think, Stephen?
Yeah, I mean, if you're talking about the idea that we live in a simulation, I think it's absurd.
Yeah.
Our universe was extremely uniform to 1 part in 100,000 up until the time of the release of the cosmic microwave background radiation at age 380,000 years. The only thing that we had in terms of matter, normal matter, was protons, electrons, the helium nucleus. There was dark matter, of course. There were neutrinos. There were a bath of photons, and that's basically it.
Yeah.
So you can't have anything, a structure, that could build a computer, and you don't have anything that allows you to build more complex structures or material until you have your first generation of stars, because all you had was hydrogen, helium, and trace lithium. And then in the first stars, you can create carbon, nitrogen, oxygen, other elements. And you have the basis for life, going forward as they recycle their material, as they go supernova and put it out into the interstellar medium. Now, touching on what you were saying, in order to have someone who's an agent of simulation, a programmer, you'd have to have multiple universes. And we don't know whether we have a single universe or a multiverse. It looks like there was some kind of inflation very early on that drove things to macroscopic scale, small macroscopic scale, from highly submicroscopic, but then allowed things to evolve from there in the way that we've observed. And the nature of that inflation and the limits that we have on it from the cosmic microwave background measurements allow still for both a single universe or for this eternal inflation idea that creates multiverses. I think Alan Guth is leaning towards the multiverse, and he's the father of inflation. Andre Lin, who's another father, leans that way. I've written an article years ago that's kind of summarizing some of their stuff, and they've both got some very nice review papers that people can look at if they want to. But these different pocket universes are extremely separated in space and time, so there's no way for one to influence the other within causality as we understand it. Even our own universe, at minimum, has to have a volume at least 500 times greater than what's within our particle horizon.
It's a new form of creationism, because
it's a new form of creation.
No, it is. It's almost like you say, let's they created the universe, right? So instead of understanding cosmology and how I love the idea that the universe came from nothing, because it's actually the simplest possible solution. And actually there are many hints for that, right? With like I just mentioned what they are, because many people say, it's impossible for something to come from nothing. No, actually it's the simplest possible thing, because nothing is unstable. Nothing is a state of perfect uniformity. And if you create even the smallest instability, there is almost like a pencil that stays on the top of his tip, and it can happen, but then the slight change somewhere makes the pencil fall. And that's how the universe was created. This was a slight symmetry breaking. For example, if you look at the difference between matter and antimatter, is 1 part in a billion or something like that. And that is how the universe created. It's mostly very, very symmetric stuff with a slightly small variation that is also breaking of this symmetry. That is what created everything else. Like Stephen was saying, there are hints of that even in the cosmic background radiation that happened 500,000 years after, 350,000 years after the Big Bang. If you go all the way, I'm sure when we get maps of a gravitational radiation background, it will be even more uniform. But there will be some small little asymmetries. That is basically the seed of everything that created all reality. So it takes more time to. There is a beautiful book that is called "Everything from Nothing." A universe from nothing, or something like that. And it goes through all this explanation of how you can get something from nothing. Actually, it's actually the most logical thing. Anyway, what is the top and then and when? I don't know. We maybe don't have a top this time.
I put out a tweet in the past week that said, Bitcoin is topless.
Yeah.
And it even had a girl, underwater. So something was being hidden.
Yeah.
If you're just going on the power law, it's topless, right?
Yes.
Now, if you ask, we still have these kind of waves. And if you look at the log periodic power law right now, you say, well, maybe there's a local top, in late November, 138,000 is what it's saying. But you have to keep updating with new data, and that number will change, and both the critical time will change. But as you get closer to it, maybe these things will come into accordance.
Yeah. So yeah, exactly. So this question, right? Um, Another interesting thing is that many physical laws are power laws, right? And some of them, at a superficial level, you can say, well, of course you get 1/r² because you're talking about a surface. But then, why do we have 3 dimension, or why we have dimensions at all, right? Um, and it's possible that this idea of a network, if Wolfram is right, that the universe is a network, in this case, a network of rules, that I love so much, because it's this so beautiful idea, that you look at this very abstract idea of possible logical rules, and then a section of these rules give us our universe. Then the way that you get these rules is through networks, right? You have basically different points in this landscape represents states of these rules, and then the connection between the states, and so the network that are developed from these connections, it's the universe. So it's a network, and then from these, then you will have a lot of power laws, because some of these networks will have nodes that are basically kind of like this idea of a preferential attachment. There will be nodes that are more relevant than others, and then power laws will be very derivative. They will come naturally from these connections. Because the networks tend to show power law basically properties. But it's just very speculative right now. We are not close. It's also true that physics is kind of stuck. You probably have heard, if you look at the foundation of physics, we are doing many progress in, the more applied type of physics, like materials, or even astrophysics, or many other fields where it's more applied. But if you look at the foundations, we did a big, huge breakthroughs in the 30s. Then after the Second World War, there were more breakthroughs, in the 50s, in the 60s, new particle discoveries, big. But since the 80s, we got kind of stuck. And, maybe this new way of thinking about the universe as a network, maybe that could be the next breakthrough. One possibility why we got stuck is that basically we reached our cognitive limit of what our human brains can do. But now that we have AI, and if we merge with AI, then this is when maybe we start to really go again deeper.
I want to demur. I want to say we're stuck because we're limited to 14 teravolts right now. Yeah. I mean, we just cannot explore the space beyond what we see at the Large Hadron Collider.
Yeah.
So we're stuck with the standard model of physics, and we have not been able to find what the dark matter particle is. We haven't even been able to completely prove that there is a dark matter particle, as opposed to, some small modification of gravity, right? And we got stuck because everybody went into string theory, and that's where what you say is relevant, that yes, our cognitive limits for string and membrane theory are highly problematic. Yeah. But we can't test it against observation.
Yeah, so there are two ways out. One, we became galactic civilization and make an accelerator as big as the galaxy. That is not impossible. Or maybe, we throw stuff inside a black hole and see what happens, and all kind of things like that. And that, will require us evolving and going in the future. Or again, if we are more intelligent, maybe we can come up with a very, very clever tabletop experiments that can still probe these very high energy fields. Right now it seems inconceivable, but maybe there is a very, very clever way of doing it. But yeah, it will be exciting anyway. So it's cool when there are still things that we need to explore and understand, right? It's no. We know a lot. What people don't understand is that the standard model that we have right now of physics can explain 99% of what we observe in the universe. But well,
Everything but dark matter and dark energy.
that quantitatively are actually 99% true.
Everything but 95%.
Okay, yeah, okay, I take it back then. Yeah.
But I mean, the other thing we're stuck on is we have no quantum theory of gravity that, I mean, we have ideas and proposals, but we don't have one.
Too many proposals.
Demonstrated.
Yeah. Anyway, physics is beautiful, and we live in a very exciting time. And Bitcoin is part of the future, and is going to help AI. By the way, I started to see a few more articles where people were saying AI, Bitcoin will be basically the fuel for AI. They will exchange AI will exchange Bitcoin. Different AI entities will exchange Bitcoin. So maybe we see another change in that slope when the AI start. If a new investor is AI entities, and this could be literally billions of them, so it will be really interesting. What do you think about that? AI using Bitcoin as a mean of exchange and rewarding.
Oh, that's what's going to keep us on the power law, because we will saturate with the number of the internet already saturated a few years ago at 5 billion users, practically everybody. And I've been talking about this for years, actually. Bitcoin will be the currency of robots and AI. There's no other obvious alternative, including stable coins. I mean, yeah, there'll probably be some stable coin use, but sats are the way to go for a bunch of reasons, right? You can have very small quantities.
Yeah.
You can attach information to sats.
That's right. I always say when people mention scarcity and Bitcoin, I don't like. One day we need to have an episode about it. I don't like to think in terms of scarcity. It's really what drives the price up. It's this growth of these addresses. The fact that more and more entities participate. And the nature of the entity can change, but the scaling property are staying there. They are very consistent. In particular, how they manifest in terms of price and time. That is unbelievable. And this also leads to this question. So, look, there are many nights where I go to sleep and think, is this idea, of scaling correct? You're taking a big bet. Many people don't even understand the claim, right? I'm really, really saying that this is a fundamental property of Bitcoin. It's not like a fluke. It's not like some kind of a model. I hate that idea, that word. It's much more than that. Right? The initial regression was there as a kind of discovery tool, and then once you realize what this means, that Bitcoin has the scaling property, then it becomes something deep. It becomes like, okay, Bitcoin is like a natural phenomena. It's really different from other assets, as its own internal mechanism. Is what the physics angle brings us. We are focusing on how, not just how, but why, and the mechanism behind. So there is something fundamental on how Bitcoin is growing that will make it continue to grow. If there are entities here that are interested in Bitcoin, and we just mentioned beyond the human beings, and we are not even a portion of all the human beings that can participate, and now we are adding AIs, there is basically an unlimited amount of joining the network, right? Of basically adoptability, if that is a word. There is an infinite amount of adoptability. And what we have shown is that is the adoptability that brings up the price, nothing else. Now, the fact that there is a finite number of Bitcoin has to do with making it a perfect ledger, And at a certain point, actually, we can dedicate a show. I have this idea of a triad, what I call the Bitcoin triad, and the fact that Bitcoin is a ledger and a perfect ledger, and for that you need a finite amount of coin, at least coin. You could even have slightly growing coins, but why make it complicated? Just make it fixed, and it's a very elegant solution. Exactly like the total energy of a universe. You can have an entire universe with a finite amount of total energy, and in fact, a zero amount of energy. The important thing that you have, every time you have positive energy, you have negative energy, and that is a ledger. It's like a ledger. The universe is a ledger that keeps track of the total energy available. And you have, anytime you create a positive quantity, like when you transfer Bitcoin, you have a hole somewhere, right? And that two things cancel each other. Same thing with the universe. Every time you have positive kinetic energy, you have somewhere compensated by negative gravitational energy. And the two balance each other, and the total is zero. And so, yeah, exactly. It's a closed system, that is good. But, it does interact with the external world too, through liquidity, etc. But yeah, and so these are all things that we can explore and understand better. But in terms of this question, right, once you start to understand these things, and this is why the power law is not, because now it's a feat. Many people say, it's based on the past. So the fact that we did this in the past doesn't guarantee that it does it in the future. Nothing is guaranteed, even the fact that tomorrow the sun will come up. Maybe there is something that we miss about nuclear physics, we don't understand it, and all of a sudden the sun runs out or explodes or does something else. There is no guarantee that doesn't happen. Nothing is guaranteed 100%. But given our understanding of the sun right now, we are pretty sure that it's going to be stable over the next 5 billion years. Pretty high probability.
We know what's going on in the core because we see the solar neutrinos, right?
Yeah, exactly. But like I say, it's in science, nothing is guaranteed 100%. With Bitcoin, we don't have that level of certainty like with physics. But this scaling property, like I say, once you start understanding it as a fundamental property, then you say this, is Bitcoin DNA. It will continue to do it. If it has fuel, that means liquidity, and there is plenty of liquidity, and that liquidity will continue to grow. And if it has people that want to join the network, and there are, and there are more and more, you can see that curve of addresses continues to grow, maybe with a different slope, but it continues to grow. And Bitcoin will go up, So it should help with conviction. It's not guaranteed, nothing 100%, but it's for sure a much safer bet than basically anything else. The stock market, gold, anything else. And this is this is why we have this show, and this is why we like to bring this level of insight that is different from others. We are trying to say, listen, Bitcoin can be understood scientifically. It's a system. It has property. It's not a mania. It's not a scam. It's something very fundamental, and probably one of the most important creation of humankind ever, and in fact, even nature, because we are part of nature and we created this thing, and so it becomes a new natural phenomenon, that needs to be understood with tools like physics, So I'm glad of it. That is how you feel yourself, because we feel exactly the same, and hopefully more people will feel in that way. The people that follow the show and they are interested in the power law. We are few but good. That is. Stephen used to say, how it goes, Stephen, that only 1% of
1% get Bitcoin, 1% of those get the power law, and then only 1% of those get that the bubble phenomena is not happening lately. So
yeah, exactly.
1 in a million, guys.
Yes, and you are these guys, people. So anyway, we will continue to be here next week and go even deeper in understanding Bitcoin. So see you next time. Bye, everybody. Thank you to be with us.
Thank you, everyone.